I titled it Fairy Tales in Singapore Real Estate. There are in fact many fairy tales or old wives' tales or stories of boogeymen and stuff. But while preparing for this, I realized that because we've only got about 30 to 40 minutes for me to present, and then I have got Q&A with you guys. And because of the situation we are in now, I have made some changes. I will be, sorry to disappoint you, presenting you one major fairy tale. But first, always ask why, right? Why am I doing this? Why are we doing this? And I get this question from so often recently. Why am I going to shopping centers to look around at the vacancies and looking around at how well or how badly the retailers and F&B people are doing? Why are we doing this? So firstly, I believe that people should not be led into bad investments, and there are many pathways to damnation in this investment market. And so I'm trying hard to try to counter market perception. Real estate investments actually require large sums of capital. You can't really get into real estate with it. It is not peanuts. You have to be, sorry, no reference to the political peanuts that we know better. You have to have a significant sum of money before you can get into investing in real estate. And since capital is precious, I would always be erring on the conservative side to say, let's protect capital. Remember, cash is king, and maybe your real estate investment might be queen, but cash is still king. And as far as possible, first protect yourself from the risk of losses before you get overwhelmed with the dreams of making money. Learn how to avoid losses. Secondly, I think that investors can put in hard work and efforts in order to learn how to grow their wealth. And definitely within the real estate space, you can do that. But there is hard work and efforts. It is not like you can buy something, sit on it, shake leg, and then do nothing and grow wealth. Know the risk and the cost before you proceed. Buying real estate is not like buying gold or buying equities. When you buy a share, you buy a bond, you buy gold, you do nothing after that. There's no monthly cost. There is no tenant for you to haggle on a contract with. There is no burst water pipes that you have got to deal with. So once you've got invested into real estate, there's monthly outgoings, and you also owe the authorities property tax. And so their liabilities, it is hard work. Once you know the risk, you can proceed. And then recognize also that we are in different stages of our lives. And we have got different expectations of comfort. Our children are at different ages. They've got all different needs. So what is one person's recommendation about investing in property would be very different from another person's needs. So once you recognize that, you would then be better able to tailor for yourself an investment package. So don't overstretch, protect capital. Okay, that's it. This is my why am I doing this? Let's dive into real estate. So I had prepared like 5 or 6 fairy tales. Today, the fairy tale that I'm going to be focusing on is if we open the doors, they will flood in. That is something that I hear so many times in the last 15 years. Oh, no problem. Singapore can just open the doors. People will come in. Real estate will be all taken up. Really, man? And because of the situation we are in now, I want to, using this fairy tale, which I will try to debunk, I want to encourage you to get out of irrelevant fairy tales and let's look at what are the structural changes facing us today. The other fairy tales that are pretty easy to debunk, A, B, C, D, wealthiest probably made their fortunes from properties. That's very not true. Real estate is a hedge against inflation. Maybe industrial and factory real estate, not residential real estate. You can own multiple properties with no money. That's a very common advertisement that you might see, you might have seen already in the last 10 years. That is definitely BS. And Singapore is land scarce, buy property, sure make money. That one is another very old adage. It is as, yeah, my grandmother probably taught this to me as well. But today, this A, B, C, D, and E are all relatively irrelevant. So once we grow out of irrelevant fairy tales, for example, I hope all of you have outgrown Santa Claus, then we focus on what are the structural changes. It will help guide us invest with much better clarity and with more objectivity in the next year or two. So this fairy tale, if we open the doors, they will flood in. Really? What attracts people to flood into Singapore? 3, 2, 1. Employment. And employment is going to be a rarer and rarer commodity now. In the past, so I graduated 20 over years ago, it was easy to say Singapore has more jobs than there are workers. So the labor force was really tight. There are a lot more jobs. No problem if you lose a job today, easy to, in fact, people were job hopping because there were so many jobs. When you job hop, you can get a raise, you can get a more senior position, or you might be able to cross industries laterally doing the similar type of jobs, such as sales, business development, finance. But today and going forward, even without COVID-19, just look at the jobs that we have created in the last few years. The highs are becoming lower, and there are more and more often lows in the market. And of course, this year with COVID, first half of the year, we already lost 147,000 jobs. These are job positions that have disappeared from the market. A survey by Ministry of Manpower for the next 2 months, the surveys were done in March, April, May, June. Over the next 2 months, how many companies intend to reduce headcount? Many companies are considering how to downsize. Many companies are considering how to do cost cutting, and cost cutting involves also, perhaps we should downsize our office real estate, perhaps we should downsize our warehouses, perhaps we should shrink our factory footprint. So all these COVID-related changes are going to impact real estate, at least negatively for at least the next 12 months. And then no surprises. Singapore's total population fell for the first time in, I don't know, I've been tracking population data for the last 20 over years. The first time I see that the total population has gotten a negative number. And of course, our most esteemed media pins it on COVID-19. But before COVID-19, we were already hard pressed to create jobs. This is a very busy table, but focus on the red circle. The red circle on the very top, it says non-residents. Singapore residents equals to citizens plus permanent residents. Non-residents are, of course, the people who are in Singapore holding passes to stay in Singapore. For the last 4 years, these pass holders, including student passes, of course, dependent passes, foreign domestic workers, construction workers, we've done negative growth 3 out of the last 4 years. Then look at these two dark blue circles. Dark blue circle on the left, total population growth. Last 4 years, total population growth, about 150,000. On the right-hand side, dark blue circle, last 5 years, total number of housing units we added to the system. This is the total number of units completed minus some of the SIRS and en bloc units that have been demolished. So on the right-hand side, the circle, it adds up to 180,000. The left-hand side circle adds up to 150,000. So we have in fact created more housing units than individual headcount growth in Singapore. And we know that each housing unit in Singapore accommodates about 3 people. So that's the oversupply that we have been building up already in the last 2 years. This last few years numbers nothing to do with COVID, because construction, once it starts, it takes about 3 years to complete for residential units. The only number here that is COVID related is really the negative 17.8 thousand, which is the population decline, total population decline this year. And if you were to look at the rest of the data, nothing really looks that good. National accounts, GDP is down, manufacturing was down during June. Retail sales is still anemic. F&B catering sales horribly negative. Of course, one of the numbers that went down that everybody is celebrating is, of course, interest rates. Interest rates have also gone down slightly, but is it able to outweigh the negatives of people losing income? So what's the damage caused by COVID? SMEs are still continuing to pack up. Some SME owners may even take this opportunity to retire early. And the segments that are under stress, even accounting, due to technology, of course, we have got a lot more automation. Even lawyers who are, say, in conveyancing, then design, events, catering, F&B, some restaurants, of course, are doing fantastic. Bubble tea shops, fantastic. But the rest of F&B, try going to Raffles Place to have dinner now. Because of work from home, Raffles Place restaurants, terrible. The boutique hotels, we've already heard of a couple of hotel closures. Salons, spas, those of you who have pre-bought 10 times packages or 3-year packages for facials and massages, please go check that those companies are still around. I walked around travel agents, there are about at least 50 of them in People's Park. Travel agents haven't opened for business for the last 7 months. Bad. And of course, for property agents, although many are still shouting that, wow, market is hot, not so sure whether it is hot for everybody. Many startups are not going to get further funding. They might have gotten the friends and family round, they might have gotten the angel investment round. Difficult, even at the VC rounds, some of them are unable to get the next round of funding. A very huge, great example, WeWork having to trim a lot of their stuff and a lot of their properties around the world. So with jobs gone and incomes going down, mortgages will definitely be affected. And if mortgages were all hunky-dory and the real estate situation is all rosy, why is it that the minister said that HDB home loans will be allowed a further moratorium until early next year? And also yesterday it was announced that home mortgages, those homeowners who have got mortgages that they have got trouble repaying due to lost income, that they can speak with their banks again to further extend the delay of payment of home mortgages. So the fact that the ministers are reacting to the situation shows that not everything is as rosy as, wow, last week and this new launch managed to sell 50%. Office and retail space, well, retail space, if you are following my post on Telegram or LinkedIn or Facebook, you will see that a lot of retail space have been given up, especially post-circuit breaker when there were construction, renovation workers who could get in and strip down the unit and then return the units back to landlords. What used to be very crowded malls such as in Tampines, maybe Century Square, I was just there, I posted up a video of it, a lot of vacancies. And the office situation now, because office leases are signed 2 years, 3 years, or even 5 to 10 years, some of the office leases are being considered for either shortening or for reduction of space, or even some of the tenants are asking the landlords for permission to sublet their additional unneeded office spaces. So those things will be panning out over the next few months. So then back to residential. My question is, where will the tenants come from if you're buying a residential unit for rental income? Again, back to that slide, jobs, right? Without jobs, they won't be flooding in. Without them flooding in, no rental income for residential space, because Singaporeans are 90% homeowners already. Very few Singaporeans rent. Then there's just a few news articles to show you, to reaffirm the point that jobs and salaries, incomes are down. Up to the middle of June, 34,000 home loans from the Singapore local 3 banks as at end of June. 34,000 home loans are under the moratorium arrangement. We haven't included the other banks that are lending for mortgages. The minister simply made this announcement based on the 3 local bank survey. What about those who applied for the moratorium after end of June? That there's no new number to refresh this story. So I'm closely watching this space. But is it really only COVID-19? Did COVID-19 hit us so hard that we can blame everything on COVID-19? Was the Singapore economy really hot and rosy pre-COVID-19? US-China trade war, presidential elections this year, Brexit has been dragging, what, 4 years and is still dragging. Struggles in Hong Kong. I mean, people are saying that the struggles in Hong Kong might bring positive investment flow into Singapore. Yes and no. If Hong Kong were a thriving economy, Singapore would probably gain a lot more than when Hong Kong is a weak economy. This is okay, next bullet point, increasingly toxic world. I have recently quit Twitter because there's just so much poison inside. And then there's the wealth and income inequality, which Singapore is not able to avoid. In fact, based on household income data, even though there seems to be annual growth in household income, the growth is partly due to us bringing in very well paid, very well qualified foreigners who become permanent residents. Some of the growth in the household income were partly due to a statistical treatment where if you have got a low income 70-year-old person quitting from the workforce, then that person leaving the workforce and having zero income would then allow the median income to shift higher. And so there's a lot of data that we have got to be careful about how we read and interpret them. Then structural changes. Before COVID, we already had technology threatening to take away a lot of the jobs. The banks are introducing a lot of e-payments. You and I have probably not gone into a bank branch anytime, probably within the last 9 months, I've stepped into a bank branch once. And that's because of certain queries that I've got to do. Otherwise, everything is internet banking, or I could call friends within the banking sector to ask questions. Why are the banks investing in technology? Is it to create more jobs? Or will the banks be able to use technology and then also shut down perhaps, say, one of the local banks has 40 branches in Singapore. With the adoption of e-payments, mobile wallets, maybe this bank can reduce its footprint to 20 retail branches, thereby saving costs on retail rentals, as well as saving manpower through technology adoption. So nobody is investing in technology really to grow headcount. So you listen to the very rosy type of prognosis saying that technology disruption is good. With technology, we will be creating a lot more jobs than without adopting technology. Somehow that message in the last 5 years have really started to show that it is not true anymore. Then for the next 10-15 minutes, what I really want to spend our time on is this point on aging demographics and retirement adequacy. And this comes together at a time when we are recognizing that HDB flats have decaying leases, and due to the decaying leases, HDB flats are dropping in value, the old ones. Okay, this is a slide to a news article to back up my point, and this was as far back as 2018, this news article from today, that technology disruption could actually hit Singapore a lot more than our neighboring countries who are not as tech savvy, meaning the tech disruption would hit their labor market a little bit later than us, because we are already adept in taking on and the use of new technology. So I have this slide with structural changes in red. To me, this is a much more important thing to discuss, because once you can have a view of the 10, 15, or even 20-year outlook about Singapore, it will help shape how you invest, where you will pick your property to invest, what size to invest in. So what are the structural changes? These are things that we cannot rewind. Aging population, you can't rewind it. Even with a longevity pill, you are still aging. So there will be increased demand on healthcare facilities. 2030, 500,000 HDB flats will be older than 40 years of age, meaning they will be left with 59 years or less of lease on them. About 50,000 people now celebrate their 65th birthday every year, because the baby boomers are now coming into the 65-year-old age. And so you've got to question, with an aging population and with our median age of death at around 83, 84 years, are we going to start seeing an increase in resale properties due to inheritance purposes? And then how about our dependence on foreigners in the workforce? Has COVID-19 changed any of this dependence on foreign workers? Do you really think that MOM, Ministry of Manpower, is able to keep its doors wide open to take in a lot of foreign workers? And with the gig economy, long-term jobs with iron rice bowl, 10, 15-year careers, those things are pretty rare these days. There's a lot more short-term jobs, contracted work, irregular incomes. Therefore, for home ownership to really continue and to be stable, irregular incomes actually goes against this thesis. In fact, we might trend towards more home sharing, especially amongst the youth. So this is has just been published last week. Our population pyramid, I hope you have seen such population pyramids before, focus on the bars. The horizontal bars say year 2020, the dots say year 2010, and then left-hand side male, right-hand side female. And on the left-hand side, the scale is in age bands of 5-year cohorts, 5-year age groups. At the bottom, of course, it is the total number of people within that population age band. Okay, so this is the cluster that is classified as baby boomers. Post-war baby boomers, they were born from around 1950 to 1970. about a 20-year cohort. So 4 batches of them. They are now they now form a very large percentage of the total population in Singapore. Then the children of baby boomers, 20 to 34 years old. This group are the ones who have been buying a lot of HDB flats in the last 10 years. And there will be a few more years as the 20-year-olds progress to become 30 years old, they will be buying HDB flats. So BTOs, new HDB flats, we still have a few more years of sales to go to satisfy these children of baby boomers who are coming of age now, setting up their family, buying new BTO flats. Then back to the oval on the top. As we progress towards, as the baby boomers progress towards the 84-year age groups, you will see that because the median age of death is about 83 years in Singapore, the number of people within each age cohort will be halved every year because that's the median age of death. And therefore, the population, as they grow older, shrinks. The total number of people shrinks fast. And this is the group, the baby boomers today. They are the ones who are more than 90% having their own homes. Home ownership is 90%. 80% of us stay in, 82% of us stay in HDB flats. So this group, as they pass away, how would they be able to hand over their HDB flats or to the next generation? Because their next generation have also already purchased HDB flats, or their children who are inheriting the HDB flats would probably be forced to sell the HDB flats to encash it and then split the cash amongst the siblings. So you see this group at the top. When they pass away, the second of the 2 old folks pass away, the HDB flat will be up, available for sale. Now, this will be for the baby boomer group, that will be about 15 years time. In 15 years time, who are the young Singaporeans who will be purchasing Singapore flats, who will be purchasing HDB flats? The number of people who will be purchasing HDB flat are way fewer than the very fat cohort that is the aging baby boomers. And so when they do pass away and they pass on their properties to the children then sell it to encash and then split the inheritance cash, they are not sufficient. There are not that many people of the young age who would be buying up these resale HDB flats. Secondly, these resale HDB flats are likely to be relatively old. This is the age cohort of HDB flats. In the 1960s, we built and we completed 117,000 HDB flats. In the 1970s and 1980s, you combine those 2 blocks, they are 550,000 HDB flats completed in 1970s and 1980s. So the aging baby boomers in the next 15 years, as more and more of them pass away, they are likely to be the ones who are, if they haven't upgraded and moved into new flats, they are the ones staying in the old 1970s and 1980s flats. The 1960s flats have either become conservation flats or they might have been searched and demolished, torn down to be rebuilt into new flats already. So focus on the 2 cohorts of 1970s and 1980s. There are 550,000 HDB flats in these 2 cohorts. And as of today, they are all around 35, 40, 45 years of age. And the valuations are dropping. This is a simulated price chart, which after me and my student produced it, thank God, nobody called us to lim kopi, which means that, and Straits Times published it, it sort of looks like it is reasonable set of assumptions. This one assumes a HDB 5-room flat in Marine Parade, bought at 860,000 in 2017. It has 56 years of lease left. And as you move down the green line, down the slope, the resale value decreases, partly due to loan restrictions and partly due to younger HDB flat buyers being unable to buy these flats and take a full home loan for it. Because the government is wary that if you are a young couple at 30 years old and you bought a flat that is left with 50 years, it will not be able to support the 30-year-old couple today over the next 50 years, means that when they are 80 years of age, they may be without a home. So that's why there's CPF restrictions and there's home loan restrictions on young people buying very old flats, which means that as the flats get older and older, the market of who are willing to buy the flats, that market keeps shrinking and shrinking, which means that if there are fewer people willing to buy your product, the price would have to go down. So this chart has been presented many times. I guess most people are in agreement that yes, the depreciation does come, the price depreciation does go along with the age depreciation of the HDB flat. So this will happen at the same time as within the next 15 years, many of the old folks will be passing away and having their family sell their old HDB flats to encash and split the inheritance cash. Okay, so it's coming together, a double whammy to press resale prices down further. And that's why recently I've been busy with creating a new course, wealth transfer with real estate. It is a course that I'm developing with Precepts Academy, together with a famous wills and estate lawyer, Mr. Lee Chi-Wee. Every family needs to discuss wealth transfer, even if your grandparents just own a 4-room HDB flat in Toa Payoh, Lorong 1. Talk to them, discuss about wealth transfer. What do you want to do with HDB flats today? What do you want to do with HDB flats in the future or after you have passed on? This is a 2-day course. We are awaiting the Institute of Banking and Finance for approval to launch the course. Those of you who have already gotten my latest book, which was published in 2017, would have also read my thesis, which I mentioned about the aging population as well as the aging HDB profile and the prices, the pressure, downward pressure on HDB resale values. Those are in chapters 1 and 2 of Preparing for a Property Upturn, available at all good bookstores near you. If you still find all these data very daunting, how to analyze the market with this confusing global economy, presidential election, Brexit, what will happen to UK, Europe, and you don't know how to select a home for yourself, select a good investment property, then engage a trustworthy agent, such as me. And this one is definitely not a fairy tale. Today's talk actually is in a 1 hour, 20-minute online course that I have designed and together with Huta learners. If you go to the website, if you're interested in getting the full details of the data as well as how I analyze this data and then the stock picking, what are the tips for picking up gems after COVID, you might want to log in here. Right now at the launch discount is the cost outline is, have you missed out on the residential market? You thought you did? Did you really? And then I went through the 5 fairy tales. I talk about what opportunities are provided by COVID-19. And then I explain how we might find the gems. Do you find the gems in the en bloc market? Do you find the gems in the freehold or 99-year market? And you look at them around, say, MRT stations, for example. I'm at the end of my presentation now. Those of you who want to keep in touch with my bantering or my complaints or my mumblings, please keep in touch with me over LinkedIn or Instagram, or I've got a Telegram group where I post up my observations about the market. And coming soon, I'll be launching my YouTube channel where my recorded videos and my presentations and my market updates will be put onto YouTube for people to reference. Thank you very much. Happy to take any questions. Yes, below 1 million might be a bit tough because based on my data analysis and my recommendations, I would still rather you focus on good districts as well as freehold. But what I have analyzed is what do I buy for myself? For example, because I'm always trying to lean on the side of being overly careful. So what are the properties that I will analyze to buy for myself? And so I'll take you through looking at maybe the master plan, looking at where some of the hype might be. And then you have got to do the homework to search, because if you are not doing the homework, then the easy way to go ahead is to look at the advertisements. The louder the advertisements are shouting, the more they are selling. But are those products really going to make money? So yeah, but less than $1 million Sing dollars property or outskirts of in the fringe locations of Singapore, small size units, I'm not sure that those are good long-term investments. No, the HDB has different sets of considerations. 99-year leasehold residences, you are the owner, you are the shareholder of the piece of land that you are sitting on. So you and your neighbors together, if you sign an agreement to go en bloc, and 80% of you sign it to go en bloc, the entire estate, because you are shareholder of the land, you are shareholder of the common area, of your corridors, you are able to take positive action to help to sell your whole development en bloc. However, if your asking price is too high, or if you cannot get 80% signature, or if you are unsure about the redevelopment potential of your piece of land, then even if you got 80% signature, you might not be able to find a developer who is willing to buy you. And that's where homework has to happen. We have seen condominium blocks that are about 40 years old, and then you walk past and you wonder, how come this block hasn't gone en bloc yet? And it is in beautiful locations in District 9. And so you then have to go reference the master plan, and you realize that, oh, this guy cannot go en bloc because it has been rezoned into landed housing. Meaning from a 5-story block, if you were to tear it down, you can only rebuild it into semi-detached or terrace houses. You are able to build less than you tear down. So there are some of these potholes that you shouldn't step into. It wouldn't be straight line, it will be kinked. Just like my graph just now, it will have a kink because at a certain point, assuming that it never goes en bloc, at a certain point, it will be restricted in terms of loans, because a person taking a bank loan to buy this property will be limited in terms of the quantum of the loan that they can take, or the total number of years that they can borrow against this property. So for private properties, anything more than maybe 40 to 50 years old, you would start to see the loan restrictions setting in from the next buyer who is willing to buy from you. And because they have a loan restriction, there will be fewer of them in the market willing to buy because they have to either take out more cash or they have to use less CPF. And so the prices will start to drop faster. And then down to about 30 years left in the lease, you hardly can get any bank loan. And down to less than 20 years, in fact, then it becomes a future cash flow stream of rental, meaning you're paying 20 years of rental to live there for the next 20 years. So who would have enough cash to take out one lump sum to pay for 20 years of future rental? And therefore, your market size keeps shrinking. Unfortunately, there is no such formula. You have got to see what's happening around your property. If around your property, we are going to put in a new rubbish dump, or you're going to have a new hospital put next to you where your block is facing the place where they put the people who passed away, then that's not a good development for you, right? So unfortunately, there are no clear, that's why real estate takes work. And those who are willing to work hard and invest in themselves in understanding the market should be able to get a better return. Those who just want the quick formulas and then apply the formulas blindly to your property is going to be tough. Yes. For example, Mandarin Gardens. They were going for sale with a sticker price of about $2.6 billion. First, yes, that piece of land is beautiful, near to the beach, but think about how many buyers are in the market able to afford $2.6 billion, and that's just to buy your en bloc. It doesn't include the tear down and reconstruction costs. So when an old 99-year property is too big, it is sometimes difficult because the buyers cannot swallow that lump sum. Yes, two very big giant developers might joint venture to buy you up. And in another example that I've seen, Far East actually split one en bloc into 4 different condominiums to launch over a few years. That's also possible, but they must first have the stomach for $1 billion or $2 billion. Secondly, it is not just the developer's appetite. Developers borrow heavily from the banks. So in order to buy the $1 billion piece of land, the developer would at least need the bank to support them at 600 million or 700 million. When the developer goes in to place the bid and then the bankers tell them, sorry, I think that your en bloc is only worth 950 million, so I'm going to lend you 60% of 950 million, not 1 billion, the developers will hold back. So it is not as simple as just considering whether it's a beautiful piece of land and whether developers have got enough stomach for it. In the case of not just Pine Grove, there is, other than Pine Grove, Mandarin Garden, there is also the owner's expectation. You buy into a 99-year-old property hoping for capital gains upside, but the rest of your neighbors have got appetite, have got very high expectations of what their property is worth. Then again, you might end up holding for a longer period to wait for the next en bloc cycle. And in the meantime, don't forget that your property is aging, and aging properties do come with a lot more physical defects and maintenance costs. So it is not a bet that should be taken lightly. Again, cash is king. Please protect your capital. My views on HDB and private markets in the next 2 to 5 years, as my slides show, please take into account the structural changes, the aging demographics, and as well the aging 99-year flats and private properties that is depressing resale prices. Also, consider whether we would be able to open the floodgates and allow many foreign workers to come in. and foreign workers will be coming in at which level? Are we able to create jobs that are paying $10,000 a month and bringing in many foreigners who will be taking the $10,000 jobs and then paying us $3,000 rentals? I think post-COVID, that would be a really tall order. Our minister in charge of the National Jobs Council, I'm still waiting for their first recommendation and report. It is like celebrating somebody else's pain, right? I haven't really seen it yet. There's a lot of talk about Hong Kong money coming in. Look, I worked in a private bank for 2 years in 2009. The Hong Kong rich and wealthy, the top 5% already have their money around here. The category of Hong Kongers who are now putting money out, they are the category that would rather buy 2 million ringgit in Penang or Kuala Lumpur. 2 million ringgit, less than $1 million Sing dollars, and with the ABSD, I seldom hear of Hong Kong money coming over due to the protests and riots in Hong Kong. So there is some news, but unlikely that the flow is big. So I wouldn't want to bet on somebody else's pain in order to make money over here. It should be a win-win-win, and then that rosy economy in Hong Kong and good, stable politics and economy in Malaysia, Indonesia, and Thailand, that really make us. DBSS is already handed over to HDB, and it is built with those rules. The day that the DBSS is completed, the keys are handed to the buyer, the rights all go back to HDB already. So unlikely that there will be it will be with the same arrangement as HUDC. Yes, you can say that, but then recognize that the rising price index is a lot of it is due to developers' new sales. So if you follow the logic, developers' new sales are, let's say, at 1,000 per square foot. But you know that in the secondary market, we are struggling to transact at 700 to 800 per square foot. So, okay, in the next 2 years, you will see developers' new sales going at 1,000 and then 1,050, 1,100, 1,200. But secondary market will still be struggling to do $800 to $900 per square foot. And in that case, once you have bought from the developer, 5 years from today, you become a secondary sale. So the question then is the secondary market going to go up as fast such that within your 10-year holding period, you are still able to sell and make money? Because everybody's property becomes old once they have bought it. And with the lockup period and your investment horizon, say between 5 to 10 years, you become a secondary property sale in that period. New property sales will probably still be pushing up the index, but your secondary property sale may not get you the profit. Furthermore, within the 5 to 10-year holding period, please consider you have got outgoings, which is your cost. Many people forgot that using CPF, they have actually foregone a 2.5% interest that they would have earned. So that is one very big cost item that most people took out of the equation. Sorry, this COVID-19, the word that we keep using is unprecedented. Unprecedented means that there is really no signpost. If you have been following the outbreaks of second, third, fourth waves around the world, look at Malaysia's numbers. Malaysia thought that they did better than Singapore, and suddenly Malaysia in the past few days, very worrisome. So how would Malaysia's lockdown situation affect Singapore? They are going for lockdown again in 5 days' time. So I wouldn't be able to say what is a trough and what is near the bottom, or have we gone past the bottom. because this is really unprecedented, means I've got no points of reference. Anybody telling you that there is a point of reference from the Great Depression or from Lehman Crisis, tell them to stand back. Because second, third, fourth waves, we've already seen in many other countries. In India and in South America, and as well as Africa, a lot of COVID-19 cases are still going on and we don't know. But if you really want to have good forward indicators, keep tracking the jobs and employment market. And that is something that I'm tracking very closely now. You are correct. That's the case. In the past, Singapore has managed to get around it by always being able to increase headcount. And because the population has always been increasing, especially when we increase population through immigration, you are bringing in people who already need housing. You're not increasing population through the route of having babies. When you have babies, it is about 20 years before they move out of the home to require a new residential unit. So that's why in the past, the erosion of the leasehold value has been less. But just now, if you followed my slides looking at the baby boomer population, and as they hit their median age of death, the number of baby boomers in the population shrinks very quickly. And then you see that at the bottom, because we have been too lazy to produce babies, and so at the bottom, there are not enough people in the next 20 years who would be in the market to buy these properties from us when our older generation pass away. So the erosion will be doubly strong. Yes, the limited land bank actually is one of the fairy tales that I am trying to debunk. Singapore is not short of land. Our very famous architect, Professor Tay Keng Soon, also confirmed that Singapore has plentiful land. We can easily build to support 10 million population today. It is whether your infrastructure and your feeling of congestion is can be accommodated comfortably or not. But yes, we actually are quite short of old age housing. We old age and singles, that is probably people who need a little bit of support. That is probably going to be even shorter over the next 10 to 15 years. One consideration is we have got at least 40 school buildings around Singapore of all sorts of sizes, including some of the past junior colleges, including ITE campus in the west at Clementi, down to the smaller size schools like primary schools that have been given up. There are at least 40 of these buildings sitting around doing nothing and trying their best not to accumulate dengue mosquitoes. But yet we are not taking the action to convert them into co-living facilities or into hostel type facilities. Only recently, due to the demand from foreign workers in the dormitories, a few of these schools have been converted into residential properties. But I think that that is one category we can use. We don't really need to even tap onto the old HDB properties yet. But of course, if we could, HDB can buy back some of these old units from citizens, especially if they are keen to help us with supplementing our retirement adequacy. Then yes, that idea is even better. Unfortunately, because they have two MRT stations, their price expectation is very high, and plus, of course, Braddell is next to famous schools, and the relative land prices in Bishan, Toa Payoh versus Jurong West is higher. So the owners then have an expectation of a much higher selling price. So in that case, that actually then causes Braddell's sellability to drop. So unless all the owners are willing to be more reasonable in their asking prices, anyway, the en bloc market probably won't be back for at least 4 to 5 years. And if developers wanted to replenish land, they would probably replenish freehold land first rather than replenish 99-year land. Actually, cluster houses are a really difficult combination. It is neither donkey nor mule, I think. So old Chinese, old Asian thinking, I want to buy a house with a piece of land to leave for my next generation. Cluster houses, you don't own the land that you sit on. You are shareholder of the land that you sit on. So because of that, cluster houses have always been a little bit difficult to sell. The internal design and layout of cluster houses are also compromised in a very big way. So I think that segment needs a re-rating downwards in terms of valuation. Yes, I've been very positive about Japan. I am keeping a close eye on Australia, UK, especially Brexit. I'm keeping an eye on Thailand, but of course the politics is not really helping. Malaysia, I think, is way oversupplied. Cambodia, I'm also very positive, especially because it is a US dollar country. You buy in US dollar, when you sell, you can transact in US dollar, you can remit out the US dollar. You can't say that for Vietnam. Very tough. And you are taking also quite a lot of exposure on the Vietnamese dong. So before you go into Vietnam, maybe you want to give me a call, and then you've got to be extra careful because of the limits, foreign exchange restrictions. The PSF is getting nearer to private housing prices. ECs have the advantages of ECs for young families. Firstly, the grants, of course. Secondly, there's still this concept of deferred payment scheme. But yes, the prices have come up to be so near to private housing prices that sometimes it is just if you understand options pricing or trading of derivatives, you're buying into a risk because you're locking yourself up for the first 5 years. You are unable to resell to foreigners, even to PRs. And then after 10 years, then it becomes fully privatized and you can sell to a foreigner. So you are buying into a 10 years of a lockup, and it is not 10 years from the day you buy, it is 10 years from TOP. So you are giving up that freedom. Let's say your career really flies. Let's say your career really tanks and you really need to get out of that investment. You are you are pretty much handcuffed. So is it worth the 30,000 grant? Is it worth that small price difference against a private residential where you're locking your freedom to divest out of it, out of the equation? Telegram is a channel that goes one way. Over LinkedIn or over Instagram, you can chat with me. And of course, you can put in your comments if you see my videos. Do remember to click subscribe so that the next time I load the video, it will go out to you straight away.